Union Pacific is my favorite railroad stock that I hold in my portfolio, and it is one we are going to review together today. We're going to look at the historical performance of this company. We're going to take a look at their dividend safety. We're going to understand the underlying metrics, free cash flow, the ROICs. We're going to take a deep dive into the company's financials, their top line revenue growth, as well as their bottom line net income growth. We'll look at the health of this company, their total cash versus their total debt, and we'll see what insiders as well as institutions have been doing over the last 12 months. And we also want to draw out some key points from their latest first quarter earnings. This was April 25th, so just a couple of weeks ago. And as always, we are going to run them through the valuation model. We want to get to our own intrinsic value as well as our acceptable buy price given that investor margin of safety. And we'll look together to see what Wall Street are forecasting for the next 12 months. So let's firstly start off and see that it does have a double buy rating, both seeking alpha as well as Wall Street, with one hold rating from Quant. It does currently sit at the upper end of the 52-week range with a forward yield of over 2%, sitting at 2.15, and a forward P around 21.36, pretty much in line with the S&P 500's forward P. We do know, in fact, over the last 12 months, it is up 22%, so fairly strong. Over the last 10 years, we can see up 150%. Bear in mind, doesn't include dividends reinvested, so it would be slightly higher if we were to look at the total return as opposed to shareholder return. And what we can see here, in fact, the all-time highs, March 21st, 2022, so 2 years ago, at around $274. So let's take a look at this company. First thing, we want to look at their revenue year on year. Now, do bear in mind, this company, the industry it operates in, is fairly cyclical, so we won't see strong growth year on year. What we know, 24 billion reported in 2014. When we take a look 10 years later, December 2023, 24.1 billion. And we can note, whilst looking at this graphical information, it has essentially barely moved over the last 10 years, but year on year we do see movements, increases some years, decreases. Again, very normal from this industry and the cyclicality. But do bear in mind, if we were to include inflation on the top line, then it would be marginally decreasing year on year. In terms of bottom line, though, that is very important. With the top line showing little growth, we do note an increase from around 5.2 billion in December 2014 to around 6.4 billion in December 2023. And when we look at it again on a graphical information, we do note it has increased over the longer term, but again, very similar to their top line, it is quite inconsistent, and again, something that we do typically see with railroads. Now, in terms of the health of this company, their total cash and short-term investments versus their total debt, they're around 1.6 billion of cash in 2014. They currently hold less than that, 945 million. And we in fact note over the longer period, their cash balance has been reducing. Is that a red flag indicator? Well, it depends. Let's look at their total debt numerically and directionally. And what we can see, it has in fact pretty much tripled from 11.4 billion to 33.3, and in fact we do see an increasing trend over the longer term. Again, whilst it is something very typical with railroads, we do need to understand when factoring our dividend safety if there are any issues, especially when analysing their net debt to EBITDA, so something we will consider shortly. We also want to take a look at their earnings quarter on quarter, and in fact over the last 4 quarters they have beat 3 out of the last 4 earnings, so a 75% beat record, so fairly strong, especially given the last 3 consecutive quarters were a beat. Moving forwards, the next quarter they are anticipating a year-on-year increase, high single digit, with the essential consecutive 3 after double digit, so very positive if they are able to effectively hit those targets. We then take a look at their valuation grade. Now, bear in mind, this is a D+, so we can take a look. The main one we do look forward to is the P on a non-GAAP basis, forward, in fact, 21.36. Now, we do know the sector median does sit at 18.75, but again, fairly generic. We don't know how good or how much in terms of the quality that is, and therefore we will take a look shortly at the performance versus just a few select others. Now, we do also see other ratings here for different valuation methods, so if you do want to use something else in your own valuation thesis and essentially investment thesis, then the information is there. When we take a look at their growth grade, they do get a D+, so a few things to point out. Year-on-year revenue growth, -4%. Sector median, around 5%. Forward-looking basis, just under 2% when the sector coming in at 6.3%. And then we can see pretty much a D across other metrics as well. One thing we do like to take a look at is essentially their growth over the next 3 to 5 years on the earnings per share. 9.5%, whilst the sector median at 12.14%. So we do note, not just on the valuation, but also on the growth, they don't have a particularly strong grade. How about then the profitability? Well, they have an A+. When we do a breakdown of what this covers, gross profit margin, very strong, 54%, sector coming in at 31%. Bottom line, 27%, with the sector coming in at 6%. So looking very strong, in fact, as we can see, pretty much A's across the board. And cash from operations, just under 9 billion, with others in the sector coming around 307 million. So in conclusion, we can just have a quick look here. Valuation D+, growth D+, though we do note their profitability does sit at an A+ rating. Now, one thing that we do want to take a look at is their performance against a few of their competitors. Now, when we take a look at this over the last 10 years, we are looking at Canadian National Railway, Canadian Pacific, Kansas City, CSX, Norfolk Southern, as well as FTAI Infrastructure. All of these we have covered on the channel, in fact, not even too long ago. So over the last year, now this is total return, including dividends reinvested, UNP up 25%, the second best, as we can see here. When we extend that over the last 5 years, we can in fact note in the top 3 up 55.52%. And when we expand it over the last 10 years, we do note, as we can clearly see, the second best, 212%, with CSX in fact beating quite significantly at 309. If we look at Union Pacific in isolation at 212, that is a pretty strong return over the last 10 years. But bear in mind, this doesn't mean that that will be how it will perform over the next 10. Just something to consider, but historically looking very strong. Now, in terms of insider ownership, it does sit at 0.26%. We know 1 instant of insider buying over the last 12 months and 4 of insider selling. Around 1 million of buying with 3.5 million worth of selling. Now, we can in fact see in Q2 no movement. In Q1 we do see just under 1 million of selling by insiders, and in Q4 we do see a fair amount of buying in comparison to selling. Now, when we take a look at who these individuals are, we can in fact see the president on the 15th of February did sell 3,750 shares for a price of $250 at just under $1 million in total. Now, very interesting to note, we can see the latest buy was by the CEO on the 21st of November to around $222 at just under $1 million. Again, in my opinion, given the latest movement is in February, a little bit outdated, so it's not something I would say to include in your investment thesis. But again, data is there, transparency is there if you do want to include. Institutional ownership sits at 80%. We see 16 billion worth of sales by the institutions over the last 12 months. We see a significant amount more of buying, 84 or 83 billion in fact, over the same period. And not just over the last 12 months, but also in the more recent quarter, Q1 of 24, as well as Q4 of 2023, a lot more buying by the institutions than selling. Again, whether or not you want to include that is something that is completely up to you. But what I would say is always do your own due diligence and don't just copy what either these institutions or insiders do. Now, before we jump into the investor presentation, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, do click on that pinned comment below where you will get instant access. We just want to point out with this article, it will essentially show you all of the websites that we do use to essentially go through and analyze stocks. Now, when we take a look at their latest, in fact, first quarter 2024 earnings from April the 25th, a few things we want to point out in terms of how they performed. At a very top level in terms of their operating revenue, what we can see pretty much in line, very marginally smaller than 2023. When we take a look at their bottom line net income, again, very marginally higher. We can see just a 1% increase. In terms of the earnings per share, again, minimal increase, but still an increase nonetheless from 2023. Operating ratio, as we can see, however, down slightly from the 2023 same quarter. So pretty much in line with how they've performed, not too far off from the same quarter in 2023. So something just to consider, but remember, as I said, the cyclicality of this company. In terms of cash generation and return to shareholders, well, they do this quite nicely. As we can see here, in fact, they have generated 2.1 billion in cash from operations, which is very significant. In fact, year-to-date 2024, when you compare it to the same from 2023, looking a lot better, a much higher 81% to 66%. And you need to bear in mind as well, with companies that are cyclical, if they are not able to increase their top line, they do need to find other ways to improve the efficiency of the business. They have also returned quite a significant amount to shareholders through dividends as well as share repurchases. And we can see something that I love to look at is that free cash flow. A lot of very strong growth from year-to-date 23 to year-to-date 24. And we also note, which is also very good, the adjusted debt to EBITDA 2.9. We're going to talk about this in a little bit more detail when we do look at the underlying metrics, as this is very important for dividend safety as well as overall health of the company. And something that is very, very nice to note, pay down 1.3 billion in long-term debt as well. So I love to see that when they are paying down their debt as well without marginally affecting the business. Now, in terms of their outlook for 2024, lots to note. I mean, the main thing that I really want to draw your attention from here is the fact that they are looking to restart share repurchase in the second quarter of 2024. The reason why this is very positive, because you will see now that this is a company that does a lot of share repurchase. One of the reasons why I do love this company quite a lot, as they return a lot of excess cash to investor pockets. So let's jump in then to the dividend safety score. They do get an 88, very safe, market cap 148 billion. They are in fact a mega cap company. So we can see their dividend safety was just reaffirmed just a few months ago. So a dividend cut does look to be highly unlikely. So no worries there, but we will deduce that from our analysis. Key metrics, well, they increased during the last recession, 07-09, below average growth, negative 21%, with the S&P coming on average around negative 12, and they also significantly outperformed negative 42, with the S&P bringing it down negative 55. Dividend growth, we are still waiting this year for an increase. However, over the last 5 years and over the last 20 years, we have seen strong double-digit growth. And when we take a look, they have been increasing those dividends for the last 17 years, whilst increasing the dividends, or in fact paying a dividend for the last 25 without a reduction. So how about dividend yield theory? Then as always, it states a company is undervalued when the current yield sits above the 5-year average. What we note here, it isn't too far off that, 2.12 versus 2.18, so we would deem this to be a reasonable valuation. When we look at the forward PE, again, not far off, 21 versus 20, so again, reasonable valuation. However, when we do look at the industrial sector PE, it is a little bit lower at 19.2. Bear in mind, any of these models that we do take a look at, we don't look in singularity and will conclude towards the end. As always, focus on the free cash flow payout whenever you're looking at payout or any information, as the earnings is susceptible to manipulation by management through accounting, and below 60% is my own personal blanket rule. It does give me faith that management will then be able to offer those double-digit dividend increases we love to see as investors. Now, below 60%, pretty much nearly every single year. We note in 23, it did go slightly higher, but the positive to note here, 2024 expected to be low at 52%. So ideally, we do see a very strong dividend increase this year. Now, I do always mention on the channel that you want to be investing in companies that increase their free cash flows. Positive to note that they have in fact more than doubled it over the longer term. Yes, it isn't massively consistent, but it is still moving in the right direction, as well as 2024 expected to be a nice increase from the previous year. Great news for shareholders, and as we covered in their investor presentation, it is looking very strong just on a year-to-date basis as well. In terms of sales growth then, again, purely, in fact, very nice to see in this format, because you can see the, in fact, cyclicality. We see some years negative growth followed by years of positive growth, and so on and so on. What you typically want to do with these companies is buy them when they are out of favor, out of cycle, and then ride them up to when they are in favor. And numerically speaking, as we mentioned earlier, their top line, whilst it hasn't moved year on year, we do see a lot of movement as it is very inconsistent. One of the things we like about this are those shares outstanding. They do a lot of share buybacks, returning a lot of excess cash to investor pockets through giving you greater control, a greater portion of the company. And as we can see, very consistently year on year, and they are expected, as they said in their investor presentation, to restart this back in quarter 2. So lots to love from an investor perspective so far. ROIC then, return on invested capital, 10% or more, just to give us faith that management are able to effectively allocate their capital. Looking very strong, pretty consistent in the mid to upper teens as well, so that is nice to note for investors. Does make it particularly attractive as well for those who are looking to buy. Operating margin, well, as I said, with a company, if their top line revenue is slowing down or not increasing, you want to increase the margins, and we do see some operational efficiency over the longer term. 36% to around 38%, although we do note some years in the 40s, and the same can be said for the free cash flow margin, looking very strong, significantly above 5% and looking very healthy. Finally, we get on to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Now, these are effectively the number of years it would take the company to pay off all of their debt net of cash on hand, and we want to see below 3. That is the blanket rule for the majority of companies. Now, it has increased over the longer term. The only thing I would say is positive to note, it has dropped in 2024, is expected to drop, and that is a good sign as long as it doesn't go above the 3. And given the fact that their free cash flow payout does also look fairly healthy, that dividend looks to be safe, and their balance sheet does look to be fairly strong. So let's jump into the valuation model, and as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First model then, the multiples valuation model, companies in a similar sector and size. The average P multiplied by the EPS of UNP to get an intrinsic value, as we can see here, showing signs of undervaluation. But do bear in mind, we're not looking at any of these models in isolation. We then have the dividend discount model. We see the average growth rate looking very strong at over 11%. Forward looking, we've been a lot more conservative, around 5.75, to give us an intrinsic value in today's episode of not too far off the market price. Now, we do get an overvaluation signal, but given it is essentially less than $1, we would say, based on the DDM, it does look to be reasonably valued. We then move on to the discounted cash flow model. Free cash flows year on year, average growth at 6%. Now, forward looking, we've gone for 12%, and that is in fact more conservative than analyst targets as well as management. With a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by shares outstanding. And we can see here again, similar to the DDM model, not too far off the intrinsic value with the market value. So we would say slight overvaluation / reasonable valuation. So the intrinsic value in today's episode is purely the average of these three models, and it does arrive to $264. So typically what we do here now is get the current price and use a margin of safety. And as always, remember, you can grab a copy of this model to get to the valuation, the intrinsic value, and the acceptable buy price of companies in your own portfolio, and those on your watch list by clicking on the pinned comment below. So 10% margin of safety, we only use that if we can execute and agree on the 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for UNP, then it is a buy around $237. Now, this is one, as I mentioned, it is one I hold in my portfolio. It isn't one that I will be looking to buy right now, given it doesn't even hold a 10% MOS level. For me to buy this, we do need to see some significant value here. For those looking to buy at a 15% MOS, a buy at 224. Those at around 20%, around 210, and those at 25% around 197. Now, for me, this is one that I hold, and I will add if I do see it between a 20 to 25% MOS level, so around that $200 to $205 mark. And as we said, right now, it has around a 5 to 10% MOS level on the price of 245. In terms of Wall Street and their expected performance over the next 12 months, they see $274, in fact higher than our intrinsic value, with upside of 12%. And as we saw earlier, they do believe this is a fairly decent buy now. As always though, let us know your thoughts in the comments below. Is Union Pacific one you're adding to? Maybe it's one you'll hold similar to me, but it's on the watch list for if it drops further, or for whatever reason, maybe you do prefer other railroads. Do let us know below. As always, if you enjoy the content, smash that like button, hit that subscribe and bell button. Let us know your thoughts, and we'll see you all on the next one.